Okay. So we have a lot of clients who are asking us a question, whether like what is LLC, whether they should organize it as an LLC, are they going to be, filing partnership return or what kind of return they're going to be filing if they are an LLC. The best way to explain the difference, or rather not even the difference, but to answer the question whether they should or should not be an LLC, there's actually two questions that we need to ask them first. Well, first question is do they know what LLC stands for, and do they know what pretty much why they're selecting this structure? Most likely they're going to tell you no, because LLC stands for Limited Liability Company. Okay, limited liability company can be anything. If it has one owner, it is automatic disregarded entity. Okay, it just automatically gets disregarded, and LLC at that point, it is simply a legal structure. It is indication of a legal structure, not a tax structure. The best example would be that the LLC is a caterpillar. Okay, it doesn't know what type of butterfly it's going to become. Okay,
Mm-hmm.
LLC may then elect through different forms to, if it has two or more members, to become a partnership, okay? Or if it has one member or more, it can become an S Corp, because S Corporation, aka subchapter S, aka small corporation, can also have multiple shareholders, okay? But if the person is a sole owner, aka one owner, LLC may become S Corporation. Now, LLC can also become a C Corp, okay? It is just a matter of which forms the client will need to submit. If the client wants to elect to be treated as an S Corporation, they will need to file Form 2553, and of course, we can do that on their behalf. Again, 2553. If the client wants to be treated as a C Corp or as a partnership, then it's entity election form. And I believe it's 8832. Give me 1 second. Yep. So it's 8832 entity classification election, and that's where they would tell Mr. IRS whether they want to be a partnership or a C Corp. Now, as we just discussed, C Corp is actually a totally different independent entity that pays its own taxes, okay? However, when we talk about partnership and S corporation, what happens is that quite literally every single tax return that you're going to see, mind you, this 1065, the page 1, would also be filled out because it would be just ordinary regular business that the company may have. This is a rental or leasing real estate company, so it's Form 8825, but even doesn't matter if you're going to see income of any sort on Form 1065 or income of any sort on 1120S, okay, for specifically federal standpoint, even if there's net income, there's going to be no payments, okay, no federal taxes due, because each shareholder or a partner will be getting K1. Now, Schedule K1, think of it as a receipt of activity of the company for each either partner or shareholder. Schedule K1s, then they show up on Schedule E, page 2, which then flows into Schedule 1, which then flows into Form 1040. Okay? I know it's a lot. I may need to create like a little handy dandy something lookup for you, like an Excel maybe. I think I created one somewhere. Maybe I have it for someone. I don't remember. But bottom line is, if someone's asking you, well, do I need to pay taxes? The answer for 1065 and for 1120S would be No, because this entity on the federal level does not pay taxes, okay? Now, from the state standpoint, states have different rules. And even though usually it's not state income taxes, there is usually some type of, I don't know, for simplicity purposes, we can call it like a surcharge tax. It may be called franchise fee. It may be called exactly that, you know, surcharge tax. It could be called various names, but for state purposes, there's usually itty bitty tiny piece, you know, of taxes that the taxpayer could have to pay. And we're going to look at Maryland, and it's a pass-through entity. So Maryland actually doesn't have any surcharges or any, you know, hidden fees that most of the other states do. Okay. So far, so good. We're on the same page.
Yes.
So to recap, 1065 is a pass-through. Why? Why 1065s are pass-through?
What is the pass-through term part?
Yes, because they pass their income through to the owners. Okay.
Via the
So,
K1s.
Exactly.
Okay,
Exactly.
yes.
Okay, perfect. So that's why these entities are called pass-through entities. Okay. Now, we're gonna grab this fella, Gene, and of course we're not gonna have his tax return because he said he only wanted for us to prepare. Doesn't matter. I'm just gonna pull up any other tax return. Give me 1 second. What did I do that was fine? Xin Zheng, I believe. It would be a good example. So whenever you're reviewing, now let's move, since this entity, for example, would pass something through to their owner, okay? What we are going to see is we are going to see these K1s show up, like I said, on Schedule E, page 2, okay? One thing to keep in mind is that it's all of these different forms, one way or another, they all show up on Form 1040. So if you will, you can think of it as a dinner table. You have your plate, which is the, let's say, main course. So that's going to be our Form 1040. And then you have on one hand side, you have all of these spoons. On the other hand side, let's say you have forks and knives, you know. And in order to actually start utilizing the Form 1040, or rather put information on the 1040, you first need to use all of the spoons and all of the knives, okay? So the way that usually works is you have various schedules showing what actually is the 1040 about. We can see wages, which is pretty straightforward. Wages go directly on here, okay? We can show interest. Interest also goes directly on here. Qualified dividends, IRA distributions, which may or may not be taxable. Pensions and annuities, again, may or may not be taxable. Social Security benefits may be non-taxable, but at most, Social Security can be taxed up to 85%, okay? So Social Security benefits can never be 100% taxable, okay?
Okay.
And this is where the quirky part begins. You're going to see capital gains or loss attached Schedule D. That, boom, right away, gives you indication. Schedule D, we need to fetch for it, okay? Schedule D, you will see, that's where we go down the list, and we're going to find Schedule D, and this is where capital gains and losses are, okay? Now, for Schedule D purposes, there are quite a few forms that actually may flow into Schedule D, okay? One of the most common ones is going to be 8949, and again, we're going to read the lines, right? So it also gives you the indication which form is most readily used, okay?
Mm-hmm.
Now, this is not the end because 8949 form is used for reporting transactions that are in one way or another not accurately represented on 1099-B, aka sale of stocks statement, and this is for personal securities and stocks only. Okay. Schedule D may also reflect sale of the home. It may be reported on 8949 if 1099 S was not issued, or 1099-B, which is rarely issued for that, and it would be considered incorrect to issue it. But ideally, it's going to show up within long-term capital gains or losses on Schedule D, and it will say Section 21 exclusion. Okay, I'm recording this because, as you can see, it's a lot of information, and you can reference it later and create a cheat sheet, and maybe even I will have time, and create the cheat sheet for you. But this is just gives you overall view, okay?
Mm-hmm.
Good so far?
Yes.
Now, you're going to see this quirky part. So Schedule D, think of it where it says capital gains and losses. It means that it could be also business gains and losses in the sense not of the net income, but of actual sale of the business assets. And this is where we reiterate that conversation about the LLC. This fella, he could have had LLC. He can absolutely convert this into LLC. If he doesn't like for it to be partnership or an S Corp or a C Corp, that's where it would have showed up, okay? Because it's going to be a caterpillar before it chooses to be anything else. So on a Schedule D now, there's this quirky line, okay? Gain from 4797, 6781, and 8824, okay? There's also 2439, 6552. So this is sale of the business assets, okay? And then these forms, it's installment agreements, related party transactions, and like-kind exchanges. We're not going to go into these right now, okay? But I just wanted to put it out there that this is where quirky stuff is. Also, on a Schedule K1, if you actually look at one of the K1s, let's say if you were to print it out, you would see that sometimes, let's say if the person actually sold a rental property and it was held in a partnership, it would be totally separate line. This is where actual gains, okay, gains and losses from the partnership, they would come here and not on Schedule E, page 2. I know it's a little bit confusing, but just bear with me, okay? We'll review a few different returns. I'll have you on a few different client reviews, and I'm sure you'll get it, okay?
Okay.
So that's when it comes to Schedules K1, most of the activity you're going to be seeing on Schedule E, page 2, okay? And these are going to be your passive, non-passive income and losses. And also you're going to be seeing that on Schedule D at the bottom, okay?
Mm-hmm.
Now, remember how I mentioned that usually interest and dividends, those are just direct entries. By direct entries, I mean that if you actually go within the personal tax return, you would click on income and you would have interest, voila, and then dividends, voila. Well, what can happen, and with this guy's specifically scenario, let's say he has quite a few of these K1s, okay? K1 could also show interest and dividends. So you will not see interest and dividends here, but rather you will see it lumped in with these numbers, and you would have to go through the statements to determine if, or Schedule B. You could actually look up Schedule B here. Schedule B, and then you would see where everything is coming from, where the interest is coming from, where the dividends are coming from. And usually for the interest, it's going to say K1, da, 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 and even if it doesn't say K1, you can look up at the name of the company. So if it's secure income fund, number 2, whatnot, you would see on Schedule B here the same name and let's say interest. Okay.
Mm-hmm.
So that's when it comes to K1s. They're a little bit tricky, but not really. Okay, not really. As long as you know what schedules they affect. Okay, what schedules they affect. Now, we kind of did it from both sides, from entry perspective and then where to look things up. If we actually go through the alphabet, right, we're gonna realize that alphabet actually starts with the A, but Schedule A is going to be all the way down here because it is for itemized deductions. I'm not gonna dwell on it right now. We can chat about it next session, okay?
Okay.
B we already discussed. Schedule B shows interest and ordinary dividends. Very important, ordinary dividends, okay? You're not going to see qualified dividends here. Qualified dividends, you can then cross-reference. They're going to be showing up in the worksheets, and you're going to see it's going to be capital gains. Let's see, qualified dividends and capital gain tax worksheet. They're going to be shown here, okay? So that's where these dividends are going to be shown. And you honestly don't need to dig that deep. You can just reference numbers from the 1040. That's only if you want to really see what's happening. So A, itemized deductions. B, that's your interest and ordinary dividends. C, this is yet again, that's where the LLCs would show up. Also, any other sole proprietorships or simply disregarded entities. Okay, the reason I'm saying simply disregarded entity, because sometimes an entity is not going to have EIN number. So in Mr. IRS's eyes, it's not even, technically speaking, organized sole proprietorship. It is simply a business that the taxpayer has. Business, major component of business is that the idea of the business should be obviously at some point becoming profitable. It is believed that the life of each business is infinite. It is believed that you should be engaged in business activities on ordinary and regular basis, meaning you cannot do one consultation in a year and deem yourself a consultant. Okay, it has to be maybe even low numbers. You could consult, just one client, but it has to be something that you're constantly engaged in. And so all of the expenses that you can be writing off for business need to be ordinary and necessary. Again, I know it's a lot, and I'll make sure we have a proper session and I can tell you more about the Schedule C, okay?
Okay.
Because it seems quite simple. However, there are quirky things like depreciation that we would need to stop and talk about, the various employee benefit programs, my favorite, pension and profit sharing plans. Let's see, deductible meals, that's easy. They're deducted at 50%. Entertainment is non-deductible. So expenses for business use of home, that's also a big one. And truck and car expenses, okay? That's a whole another thing that we can also talk about later on, okay?
Okay.
Schedule D, capital gains and losses, we touched on it, okay? So we talked a little bit about that. Schedule E, and this is very important. This is where a lot of people get confused, okay? A lot of clients get confused. A lot of tax preparers, when they just start out, they get confused. It's important to remember that Schedule E, page 1, is your supplemental income and loss that reports two things. It can report royalties It can report short-term rentals, it can report vacation rentals, or it can report long-term rentals. The reason I said two things is because it's either going to be royalties or some type of rental, okay? Because I kept on naming. So that's your page one, okay? Now, even though it is called page one, if you have, like this fellow, for example, if you have, what is it, 10 different rental properties, you can have many page one pages. This is important, okay? You can have Schedule E, page one, page number one. You can have Schedule E, page one, page number two. You can have Schedule E, page one, page number three, and so forth and so forth, and you can keep going and keep going, okay? What matters is it is filled out, everything, all the rental and royalty income is going to be shown on page one of Schedule E, okay? Now, this is Schedule E, page two. Again, you can have quite a few of these, but usually it is simply stated as a, you usually just use statements. So in this one, even though technically speaking, you could create Schedule E, page two, second page, nobody really does it. Software doesn't do it. I actually haven't seen any software do it. So in theory, is it possible? Yes, but it will be very, very confusing for Mr. IRS because this is where you actually summarize all of the passive and non-passive income, okay? So if there's more than a few partnerships or S corporations, if there's going to be K1 from a state or a trust, usually if they don't fit within these lines, you're going to go all the way down and you're going to search for a statement, okay? The good news is that software is going to tell you what statement number it is. So for example, if there were many more of these, it would tell you statement number 6, okay? Or like statement number 8, doesn't matter. So that's when it comes to the Schedule E, page 2, A, B, C, D, E, F. F is farms, okay? We don't really do all that many farms. So farms are quirky in a way that they do behave almost as a Schedule C. Problem with the farms, with the Schedule C, with the page 2 of Schedule E partnerships in particular, is that these are subject to self-employment taxes, okay? Subject to self-employment taxes. I feel like if I elaborate any more on anything, I'm just gonna completely dump too much information on you. So how about this? I'm going to pause this recording. I'm going to share it with you. If you want, maybe over the weekend, if you're gonna have a little bit of time, if you could just use this fellow as an example, his return has been filed. If you want, you can poke around in his documents. I do believe we have them in Dropbox. So take a look at his documents, at his W-2s, at his interest statements, whatnot. And then maybe if you have questions, we can do a session and you can poke my brain. How about that?
Okay.
Sounds good?
Yes.
Okay, awesome. And what I want to do, starting next week, I'm going to pick a few returns. Once you go through this guy, once you see a little bit, what goes where, let's do a session. You'll tell me what you've kind of comprehended and, what schedules are used for what, okay? And then starting next week, I'll select a few, let's call it medium, level, a little bit easier type of tax returns for you to review.
Okay.
Once you review them, you let me know, let's say you're done, you've reviewed, I'll do a once over, and then maybe, we can get you to kind of up to speed so we can get you on that track, to start becoming a reviewer so I can rely on you more, okay?
Okay.
All right, my friend. So I'm going to go ahead. Um, oh, that's wonderful. I think it's going to stop recording once we actually end the session. So, awesome. Any questions for me, like immediate ones? Anything you want me to elaborate on?
No, because I feel like it's something that I would have to kind of review on my own just so I would know what the questions were.
Awesome. Awesome. And I think, you know, once I have you take a look at a few different tax returns for review purposes, right? Maybe then you will actually have more of these very, very specific subjective questions that we can go over. Okay?
Mm-hmm.
Okay. Awesome. Thank you, Patrick.
Thank you.
Okay. Bye-bye.
Bye.